All right. So we're on day 2 of Phoenix Startup Week. My name's Kate Rogers-Seeker. I'm coming to you from UAT in beautiful Phoenix, Arizona. I'm joined today by a friend and colleague and community evangelist alike, Hamid Shojaee, right? Did I pronounce that right? Am I close?
Shojaee, yeah, it's close enough.
Okay, I tried. I actually practiced.
Oh, I appreciate that.
So we're gonna let Hamid take over here in just a second. Okay, Hamid, you ready?
I'm ready.
It's all yours.
Share my screen. Okay.
Yeah.
Hold on.
Thank you so much. I'm gonna go away.
Absolutely.
Take it away.
All right. Let's do this thing. So the talk is obviously about how to evaluate your idea, then build, fund, and sell your company. So we're going to be talking about a few different things, and we'll just get right into it. The first is an idea, the idea portion of the talk, which when you have an idea, the biggest question you have is it any good, right? And it's hard to evaluate an idea, but I'm going to do it for you right now. And I'm sorry to say that right off the bat, your idea sucks. Is it any good? No, it's not. It sucks. It's going to fail. And I can say that with a high level of confidence because I will be right more than 90% of the time. I don't even know your idea. And with over 90% accuracy, I can predict that it will fail. Like that's crazy. And it's literally better than Larry Bird's free throw percentage, an NBA legend. That's how good I am. Or am I, really? Imagine only saying your idea sucks and it will fail and being right more than 90% of the time. In fact, that's literally all naysayers do. And they're that good by just saying, no, it's going to fail. The people who sit on the sidelines, do nothing and say, I could have told you that would have failed. Those people are right more than 90% of the time, which is kind of crazy, right? Well, you know what? Fuck those people. And unfortunately, I have become one of those people. I will spend a few minutes to evaluate an idea, and based on my limited experience and based on my preconceived notions, I will make a judgment of yes, I will invest in this, or no, I will not invest in this. And most of the time I'm going to say no, I won't invest in something. And if I'm saying no, I won't invest in something, what that really means is that I'm saying that it probably is not going to be a huge success, that it will return some income for me, right? So I'm essentially saying your idea is going to fail. And as an entrepreneur, your job is to have conviction in your idea without needing anyone else's confirmation. I'm going to tell you a quick story about Chris Sacca, who is a highly successful, now a billionaire investor. He invested in huge companies like Twitter and Twilio and Uber and so many other successes. But when he heard Airbnb's pitch, he told those guys, listen, this is a terrible idea. You're going to have someone get murdered in someone else's house. You're going to be responsible for that. Just, you guys are smart guys, go do something else. So one of the most successful investors of all time turned down an opportunity to invest in one of the biggest, most successful startups of all time, which is now over $100 billion company. The reality is that we are not nearly as good as we think we are. I've never heard an entrepreneur say, when I pitched this idea, everyone loved it. And they thought I was the perfect person to build it. That just doesn't happen. No entrepreneur has ever said that. So when you're evaluating ideas, the question really becomes, are there ideas that are better than others because their time has come? Are there ideas who it's right now their best time and opportunity to succeed? And the answer to that question is hell yes. Just think about until the iPhone came out, Uber would have been impossible to have built. So you may have had the idea for Uber and tried to build it for 20 plus years prior to the iPhone, and you would have failed every single time. Because the idea's time had not yet come. And the iPhone made hundreds, if not thousands of ideas possible, and their time to have come. And when it does come, when the time for an idea comes, as it did with the iPhone, there's a lot of competition because people all see it. And there, Uber was in that competition because lots of ride sharing type of apps started to flourish. And then it becomes, which one is going to disrupt? And in Uber's case, it disrupted the taxi business forever and in a big way. Ideas that blow up other businesses can be described as disruptive ideas. These are ideas that sort of marry new technology, as the iPhone did, with business or consumer expectations. Because now, if my phone knows where I am, I have different levels of expectations of what my technology can do and what my software should do for me. And when you marry those things and you get huge benefit, the combination, the intersection of those is what becomes a disruptive idea. There are tons of examples of disruptive ideas, like podcasting disrupted traditional radio, or online shopping disrupted retailers, or on-demand video like YouTube, Netflix, Hulu disrupted TV. And EVs right now, like Tesla, are disrupting the car industry in a massive way, right? So what makes a disruptive idea? Easier or better or cheaper are the key ingredients. It has to be easier and a lot better, a lot cheaper than existing solutions to solve a particular problem. Ideally, a combination of all three, but any one of these could potentially be a disruptive thing. And it can't just be a little bit easier or a little bit better, especially since easier and better are very subjective. But with cheaper, maybe because that one is an actual price, it needs to be substantially cheaper if it's on par or better than something that already exists. But if you can say something is 10 times easier or 10 times better than existing solutions at half the price, that's the type of thing that becomes a disruptive idea. So when you have your idea, or when you have your prototype, or when you have your early versions of your MVP, you want to run it by your target audience and ask them this question of, is this something that you find to be easier or better or cheaper than existing solutions? If we were to use a disruptive technology that has taken over the market, like digital cameras as an example, when you take digital cameras and take it to consumers and ask them, is this easier than taking film-based photographs, sending your film in to develop, and then having those developments come back a week later and finding your picture to be fuzzy, versus a digital camera which gives you a photograph immediately and shows how good the photograph is? Of course, the consumer's expectations are just absolutely blown by the easiness of a digital camera. So, but if you took that same digital camera to the wrong target audience, which would be, let's say, professional cameras early on, or professional photographers early on, those professional photographers would have told you that the digital camera is worthless to them because the quality of the pictures are too low resolution, which is what they were early on. They were too low resolution for them to be any good, for them to be able to print them or use them in their in newspapers and articles that they did for magazines. So professional photographers would have had a totally different perspective on digital cameras. But so knowing your target audience is super important. So in every industry, there's also another consideration, which is that the market in any given industry or technology or product area grows in an S-curve over time. So if you think about an S-curve, at the beginning of time, there's like nobody who's using that technology or that product. But over time, as it gets slowly adopted more and more, there's a lot more people using it. And eventually, everyone who could potentially use that type of technology or product already has a solution. So there's a great time when you think about the market growth of any particular industry, technology, or product. There's a great time to get into it, which is somewhere around that time frame, which is at the start of when things are really getting traction and growing exponentially and about to explode. And there's also a bad time when it's too late, because everyone who wants a solution already has one. At this point, you have to get people to switch from an existing solution to your product. So, if we take industries that everyone knows, like cell phones, for example, AT&T, Verizon, Sprint, T-Mobile, four winners. Everyone has already picked their team, one of those four generally, and nobody is switching. Essentially, there's billions of dollars worth of advertising going in by AT&T, Verizon, Sprint, T-Mobile, and all of the switching that happens throughout the year, at the end of the year, each one of those companies pretty much has the same market share that they did at the beginning of those companies, beginning of the year. But if you backtrack to when cell phones were starting to get traction, when most people didn't have cell phones yet, but it was obvious that cell phones are the future and everybody's going to have them, that exponential growth curve, that's when real companies got made. That's when AT&T, Verizon, Sprint, they became who they are because of the early growth by offering a product that was compelling to the marketplace. So there's also another time when it's really hard to get into a market, which is at the very beginning before the market exists yet. So like, for example, when Tesla started in 2003, it had to go out and convince people that they needed EVs in the first place. People didn't think that they need EVs, right? They already have a solution to their transportation problem. So it's much more difficult to convince people at that early stage. Imagine selling email in the 1980s when nobody knew what email was. You had to convince them that they need email before you could even sell it. Now, by the 90s, people were already convinced about email, and most people didn't have email yet. So if you were starting an email business in the 90s, that would have been a great time. So that would be the great time. 80s would have been too hard. Today, everybody has email. So trying to come out with an email solution today, unless it was going to disrupt email, it would be too late. And therefore, that idea will most likely fail. So it's sort of easy to be able to map an idea on an overall market and determine whether or not it will succeed or fail. Not super easy, but some things you can sort of plan for it in this way. In fact, there's lots of examples of this too. So Apple, for example, when they came out with the iPod in 2000, there were already more than 100 MP3 players on the market. So they weren't first to market, but digital media players were just barely getting traction and growing exponentially. Same thing when they came out with the iPhone in the smartphone business. Microsoft has done this in numerous different fields, and Google has done this as well, whether it's been with Gmail, which they released in 2004 timeframe, or a variety of other products like Google Docs. And they disrupted in different ways. With Google Docs, they did it because people were going on the web. So there was one technology disruption combined with a price disruption, which was significantly lower price than anything else. So in these cases, they don't need companies or consumers or businesses to switch from an existing solution, from an existing smartphone, from an existing MP3 player to theirs. They just need to get more of the new people who are coming into the market. So if you're coming in at the early part of this S curve, vast majority of people don't have a solution yet. So if more of those people are choosing your solution, then over time, you're going to have a bigger market share, even if there's established players already in the space. So you don't need to get those people's customers to switch over to you. You just need more of the new ones. All right, so let's assume you have the perfect idea whose time has come. Now it's time to actually build it. Now, the first question I have for you is, can you build it yourself? You know, when people come and pitch me ideas, that's my first question. Can you build it yourself? And if the answer to that is no, that's a problem. My second question is, can you find a co-founder who can? Can you find a co-founder who is just as excited about you are about the problem area, who has the expertise to build it? Because here's the problem. If you and your co-founders can't build the solution that you're talking about, that you're pitching, then what is your company? Is your company an idea company? Because I have lots of ideas that I can't build myself. Is it a sales and marketing company? What is it? What is your company that you're pitching? The number one reason that I reject investing in a company is because the team wants to outsource or has already outsourced the product development or wants to raise money to outsource the product development. They want to raise $1 million so that they can spend $500,000 of it on the product development itself. When that's the case, I ask them, what is your company? And generally I'm getting pitches for like software or SaaS company pitches. And these software ideas almost always have the obligatory, we're going to do AI for this or that, and we're going to use blockchain in this way or that way. They incorporate all the buzzwords into it too. I love that, especially from people who have no idea what software is, but they're trying to build a software company. In all of these cases, I ask them, what is your company? And if they come back and say, we're building a software or tech company, then I am out, because it doesn't make sense for me to invest in a company that's going to outsource its core competency. If they're outsourcing their core competency, I may as well invest in the company that they're outsourcing it to, right? In most of these cases, when I ask them, what is your company? I hold my fingers and I'm like, I hope that they know that software or technology is not it. And they come back to me and they say, we're a sales and marketing company. We're so good at sales and marketing that we could sell ice to Eskimos. That's how good we are. We just need to like build this product outside of our company because we know we can sell the shit out of it. And if they came back and said, we're a sales and marketing company, that would be a much better sales pitch than we're building a tech or software company and we're going to outsource the development of it to India or to some firm that's not them. All right, so you have to understand your core competency. And if you're building a tech company or if you're building a software company, you have to have that core competency on your team, ideally in your founding team. You should be that person, or your co-founder should be that person, and you should be bringing the business side of things. So let's say you have your team. Now it's time to build your MVP. And there are tons of info on what the minimum viable product looks like. So I'm not going to go too much into that. In fact, I think there's a session later this week with Eric Ries. I highly recommend it. But it suffices to say that you need to build something that actually demonstrates the easier, better, or cheaper part of the existing over an existing solution that is out there. So you have to build the minimum viable product that shows the better or cheaper or easier solution. And once you have that, you want to build excitement around it, which is extremely hard to do because you've created an MVP. You've created something that's very, very small, relatively easy to do. And most companies or most consumers are not going to pay you for this. So how do you build excitement around it? Because it's a like minimal viable product, right? So how do you build that excitement? If it's cheap, one of the easiest way to build excitement around it is to give it away for free. Free is a powerful motivator. You want to prove your product. You want to prove that it works. So take away all the barriers to entry, give it away for free. You get feedback from real users. You get some actual customers using your product. And you might even get some testimonials out of it, right? This, for some reason, whatever reason, creates a huge mental block for people because they think that they need to make money on every sale that they are making. And you don't need to make money on your first 10, your first 100,000, in some cases, tens of thousands, maybe even millions of customers, depending on your market opportunity size. The reality is that most big software successes started with free. Think about the products that you use every single day, whether that's Google or Facebook or Twitter or YouTube. And it's not just on the consumer side of things, in B2B as well, like HubSpot or Slack or Trello or GitHub. All of these companies, they all have free offerings that have something useful. And in early days, they only had free offerings, by the way, because building out the payment systems to actually take people's money is very, very difficult thing to do. It takes months of work, months of development work on something that you may want to throw away because the product itself may have not worked. So why even bother building the ability to take money when you can put all of those resources into building the product itself, make the product that much more awesome. Give it away for free. You don't need to make money off of the first bunch of customers. And then eventually you can come back to figure out how you're going to charge for it. So, okay, on to the next topic, which is funding. So far, we've talked about funding. We haven't talked about, rather, funding your idea. The hope or assumption is that you could get it to this stage of building your MVP, building something that can excite people without needing outside funding. Either using your own money or working nights and weekend, or getting a friends and family round where, you know, friends and family might not need the kind of return that typical investors would be looking for. Now, once you actually have something, the easiest way to raise money is to have this graph. You need to have this graph in your pitch deck. If you have this graph, investors will throw money at you. Now, notice that the graph doesn't have dollar signs in it. It doesn't have amounts in it. It doesn't even have numbers in it. The main thing that you need to show is something inside of your company, product, idea, etc., whether it's dollars, revenues, users, leads, whatever, is growing over time, and it's growing in a consistent basis, and it's growing exponentially. This graph could be anything, right? It doesn't have to be dollars. If it's dollars, it's super easy, because if you can show this graph and put, you know, this is how much revenue we had in April, and we almost doubled it in May, and so on and so forth, then it's every investor sort of understands dollars and will throw money at you. But if you could show it even as users or leads, or you know, some other metric in your company that is super important, number of hours of the product used. In some investors, a lot of investors out there will understand it, and they'll throw money at that. So this is the secret to raising money. Have this graph. You can copy and paste it into your own pitch deck, but you need to have labels on this graph that is referring to something that is real within your company. If you don't have that yet, work on that. Work on figuring out what you can double over time, over some period of time, or you can triple or quadruple and so on. Because if you have this graph, then the discussion becomes around what is the total addressable market in your field, or TAM for short. So how do you figure out the TAM? There are two ways. Either you're going after an established existing market where the total addressable market is very well known for, or you're doing something totally new, which is rare. But if you are, you can multiply the product price that you have by everyone who could possibly use it, and that becomes your TAM. So in the existing market example, the future of the car industry, for example, is electric vehicles, right? So if you're in the EV business, you argue, you know, if you're trying to sell electric vehicles like Tesla is, for example, you argue that the TAM in our space is all the cars sold, because they're all going to be electric someday. So the market opportunity happens to be $1.5 trillion worldwide. That's a ginormous market, which is why there's so much excitement around Tesla, because they're playing in this massive market, and they're now at a perfect time. That exponential growth curve of the S shape, they're only at 2% market penetration, 1 to 2%. So 98% of people don't have, possibly 99% worldwide, don't even have electric cars, but they will someday. So that opportunity is enormous. So when you respond to this question of what is the total addressable market of your company or your product, your idea, this is where you have to have a number that's in the billions of dollars. Now, why billions? Because investors are already millionaires, right? Now, I think, you know, it seems like a stupid reason, but seriously, think about that. If you are an investor, and chances are you're a millionaire, in fact, you have to be by law, which is kind of crazy, but why would you go after small opportunities where, if the company is successful, and remember, most companies are going to fail, so if the company that you're investing in is going to be successful, if their total addressable market is in the tens of millions of dollars, why would you invest in that company? Because the return potential is relatively small, especially since founders think their companies are worth a gajillion dollars, and they're going to give only a tiny fraction of it to the investors. So investors are looking for opportunities that are in the billions of dollars, so that since most of their investments are going to fail, the ones that make it are going to provide a return for them that is actually meaningful. Now, we just talked about the total addressable market, but speaking of acronyms, if you are going to pitch to investors, you are going to have to know your acronyms. And these are some of the common acronyms that come up for especially software or technology companies. People want to know the total addressable market. They want to know the customer acquisition cost. They want to know the MRR or the ARR. That's the recurring revenue model that most companies are built around these days. They want to know the average revenue per customer or per unit that you sell. They want to know the lifetime value of a particular customer. Like if you get a customer, how much is that customer going to give you over the lifetime of that customer? And the only way to know that is to know what your churn rate is for customers. So if you have 100 customers, how many of them cancel in a given year? I actually have a separate talk about how to figure out your SaaS numbers. These are called SaaS metrics. And I have a talk that I can link to in the Q&A afterwards that I'll link to. But know this information. Now, if you're a brand new company, you have no customer acquisition cost. Even if you might have pitched to the initial few customers yourself, you're sort of at the early stages. It's okay to say that I don't know what my CAC is, or I don't know what my LTV is right now. But know the acronyms so that you can speak intelligently to them. It's actually worse to say, oh yeah, my CAC is $27 per customer, or even worse, $27.18, when you only have 8 customers and you talk to every single one of them, because that number is not real. You know nothing at that point. But know that you don't know your CAC, because your CAC is really the amount of money that you have to spend to acquire new customers on a consistent basis. It's the total amount of your sales, marketing, and advertising budgets, essentially, divided by the number of customers that you get in a given period of time. It's also okay not to raise money. That's how I built my company, Axosoft. I built the initial product working nights and weekends. So it didn't cost me anything to build it. And I put it out on the internet for others to use for free. And guess what? Lots of people started using it. And they started giving me all kinds of great feedback. And once I had that feedback and people using it, I had this sort of like cycle of iterations where I was continually improving the product. And eventually I decided to charge for a future version of the product once I had thousands of users. Now I had thousands of users, then I got a handful of people paying me over a period of several months. And I'm talking single digit numbers, right? So I went from thousands of users who were using the product for free to 1, 2, 3, 4, 5, 6 paying customers over the course of 3 months. But I didn't need that extra money. And what I did is I respent it on advertising and Google ads and trying to get more customers. So I built the company organically and profitably over time. Eventually, I left my full-time job to go work on it on a full-time basis. Eventually, once there was enough money to pay for an employee, I paid for an employee and built the whole thing organically and profitably. Now, the nice thing about building something organically and profitably is that you don't have to answer to anybody. You don't have to answer to investors. You don't have a board of directors. Nobody's breathing down your neck. And you don't need to know your acronyms. You can just know the fundamentals of your business, which is, hey, I need to build something. I need to charge something for it. And essentially, I need to pay for all my expenses. Those are the fundamentals of business that everybody understands. And you don't need to feel stupid going into an investor meeting. But if you do go out to investors and you do raise money, you do need to start thinking about your exit. Which brings us to the last topic of discussion, which is the exit. So what is the best way to sell a company? And the answer to that is pretty simple. Just be the number one in a particular category. It's very easy. Very easy to say, that is. Much, much harder to actually do. But what happens is when a giant in your industry decides to get into your specific field, and there's always giants in the industry that want to get into some field that's lucrative, They go after the number one independent company that's available to buy. That's just an automatic playbook of ginormous corporations. That's what they do. So if you're the number one SaaS supplier to, let's say, hair salons or to tire retailers or to fastener makers or whatever category of business, you can generally get a premium price for your company from a strategic acquirer who can take your company, plug it into their system, which is much, much larger, and probably 10x your revenues relatively quickly. And that's why they're a strategic acquirer like that is willing to pay a premium for the number one. Now, nobody in that position says, let's go after the number two or the number three or number four company in this space. Unless the number one is not willing to sell or is already sold, then they go after the number two or three and so on. So what if you're not the number one, or you're not necessarily, you're playing in a crowded field, but maybe you've built a good, profitable business. There's still hope. It's called private equity. There is so much investment money out there that there are literally hundreds of companies whose job it is to buy profitable companies and keep operating and growing them, literally to sell to another private equity firm. That's all they do. Because there are hundreds of private equity firms. It's kind of nuts. The amount of investment capital out there has grown to such levels that there are enormous number of opportunities there from private equity firms. Now, if you end up going this route, you might consider going through an investment banker who can actually get you in front of more and more of these private equity firms, because oftentimes they have relationships with them and they know of most of them. So they have contacts to be able to build you a pitch deck and go pitch it to 200 different private equity firms. That's what we did with Axosoft. We used KPMG as our investment banker, and they had tons of relationships. They pitched the company to a bunch of private equity firms, and we got multiple offers, actually. Now, private equity firms are not going to give you the same level of returns as a strategic acquirer, because to a strategic, your company is worth a lot more because they can take your company, they know they can plug it into their system and expand its revenues. To a private equity firm, your company represents somewhat of a risk because they have to assume that they can do the job better than you can and continue to grow revenues and profits and hopefully turn the company around at some point down the road for some multiple. They're not looking for a 10x return. Oftentimes they're looking for a 3 to 5x return. So that's basically it. We talked about the 4 different subject areas, and now we can jump into Q&A, and I can answer your questions. So feel free to throw them into Wova, and I'll try to jump in there and answer them for you. Or if Kate comes back, she can ask them from me, and I can answer them in person. So
Yep, I'm here.
All right. Awesome.
Okay. We got 3 right now, and I have a feeling we're going to get more because there was a lot of engagement. So here we go. Number 1, do you have thoughts on building an MVP using a no-code platform?
I don't have thoughts on that because I don't have any experience on no-code platforms. But again, if you're building a software company and you're trying to avoid writing software, there's something wrong with that picture, right? So just think about it like this. It's like if you wanted to build a car company, but you were going to basically outsource all of the development of the car to someone else, to Ford Motor Company, and then like what are you going to do? Are you going to be a sales company? If you are, then don't call yourself a technology company. And I'm not saying there isn't a market for that, but understand what your company is, because if you are going to outsource the development of your vehicle to Ford, then you're not a car company, but maybe you're asking them to build you a specialized vehicle that you can sell a ton of, because there's a market that is unmet that you are seeing that nobody else is. So in that kind of a scenario, it could potentially work.
Yeah, it seems like that the decision on how you define yourself also is a good North Star in how you spend your money and how you invest and determine your success.
Yeah, that's
Here's
exactly right.
here's the second question. How does the
Go for it.
speaker feel about engineering challenges versus scientific challenges, meaning that engineering can be done and scaled, whereas science is a point of discovery?
I'm not sure I fully understand the question, so feel free to elaborate on that, whoever is asking that question. But engineering challenges or science, like if you're talking about, for example, let's take full self-driving vehicle. I'm not sure that would be a scientific challenge or an engineering challenge, but it's a software challenge in that particular case, which is very difficult to accomplish. Lots of unknowns, and lots of people have been thinking that they're really close to it for many years, and they haven't achieved it. To this day, Tesla hasn't achieved it, but Elon Musk has thought that they've been months away from having it for 5 years now. So he's been wrong that whole time. So there's all kinds of challenges when it comes to trying to predict exactly when a particular technology is going to come together. But if that's what you're building, that's what the investors are also taking a risk on, because there's in the case of FSD, this is something that might be worth $1 trillion. So there are many investors who are willing to risk billions of dollars for potential trillions of dollars in return. So that's always the game that you're playing in that sense.
Okay. For a SaaS company, how do you determine the L of LTV? Theoretically, this could be decades, correct?
Yeah. So that's a great question. Like lifetime value is one of those questions that you have to know the attrition rate. So I'll see if I have. Actually, it might be hard for me to find a quick slide, but I should be able to explain it. Let's say you have 100 customers, and in a typical year, you might lose 5% of your customers. That means you lose 5 out of the 100 customers, and your attrition rate is roughly 5%. If you were to extrapolate that, what that really means is that your average customer is going to stay with you for 20 years if your attrition is 5% per year. If it's 5% per month, then it's 20 months, right? And by the way, all of those are normal ranges for software companies, 5% per month, all the way to 5% per year, which is incredibly good. But then now you know the average length of the average duration of a customer, which is either 20 months in the 5% per month example, or 20 years in the 5% per year attrition rate example. And you can take that and multiply it by the average revenue that you get from your customers, and that's what your lifetime value is. So a very easy example would be if you have $100 a month in revenue and your attrition is 5%, that means the average customer stays with you per month. That means the average customer stays with you for 20 months. So 20 times $100 means your lifetime value of a customer is $2,000 in that example. And I go through a lot of those details, and let me see if I can pull up the SaaS metrics talk. I'm going to put that in the where should I put it, in the chat for Zoom, or
you no Vhat, if you can go in there, that's where all the maybe I can have it. I can have it pinned for you. I can have it pinned for you. I'll just move on to the next question.
Okay. I posted it in Vhat. So
okay, perfect. Thank you. So it says great framework. If any would. Okay, hold on. Is the exit strategy something I should think about if I need to attract investors? If I am just to do it on my own, should I think about it? I always feel like I think about selling my startup when I am building it. It was really discouraging personally. Okay.
Yeah, so no, I totally get that, because the last thing you want to do is build a company around selling it, and when your mentality is such that you're building something to sell, you don't have the same level of affection or love for what you're creating. And I think that might be what you're sort of alluding to. And I agree, that's a challenge. I think what you have to keep in mind is that if you go out there to get investment, that is something that's going to be important to the investors, right? Because if they put in money without a sale at some point down the line, that means that they're just dumping money into an open pit, right? It's just never going to come back. And that's not what investors do. So you have to balance building a great company that people are going to love, the culture that you want to build, the kind of company that you want to have and run forever. But you have to build it in such a way and go after a market in such a way that there is an opportunity for an exit down the road. So you as a founder should be building something that you want to stay with and live with forever with a very long-term mindset. But keep in mind that the investor is going to want to know that somebody is going to be interested in putting money into this or buying it from you at some point down the road, or for your company to go public, which is another way for them to have return on their investment. But just going public is such a rare event for companies.
Awesome. So this question says, great framework. What, if any, would you change in your framework for a decentralized community project startup?
Decentralized community project. Am I to assume that that's nonprofit? If so, then you can throw away the entire presentation. It's sort of like I'm not sure if it's for a for-profit decentralized community project. It seems like it would be difficult to get a lot of other people, like community members, interested to do something for profit for others without personal gain. Now, there are community companies like Nextdoor is a perfect example of a community-driven company where Nextdoor is a beneficiary of it, but the community does get the benefit of, well, Nextdoor is the financial beneficiary of it, but the community gets the benefit of being able to talk amongst themselves, right? Because each community gets to know their news and what's going on in their neighborhood and so on and so forth. So the community is contributing content, but Nextdoor is reaping in all of the financial rewards of that.
Yeah, I'm thinking also about the work that we do here, which is very sponsors driven, right? We go for economic development sponsorships and and local sponsorships. We are not a for-profit though. We're just putting on we're putting on stuff. It's not software specific.
No, but in your case, it doesn't matter, right? Like most of what I talked about in the presentation is probably not relevant, just because people want to do and contribute to their community because they want to help. They're doing it for other reasons than financial gain.
Right. How do you calculate valuation of a software company in MVP stage?
So, yeah, that's a great question. I mean, you can't really calculate it very well, which is why safes have become like the way in which most companies raise money these days. And the safe is sort of a way to not put a price on what the company is worth. They take it as a convertible note. It gets priced at some point down the road. In the case of safes, there is usually a cap, a maximum conversion amount, where if the company is super successful and does get to raise at some point down the road, maybe there's a cap of $4 million or $5 million where the money gets converted at. If if you're relatively new, you're at the MVP stage, you don't have revenue, it's hard to value companies, which is why the safes are generally a good practice, good use. Now, when you're going out there and raising somewhere in the, let's say, $500,000 to $1.5 million range, typical safe cap is going to also be in the $3 to $5 million range, so that like there's an opportunity for investors to have a great return without diluting founders in a significant way if the company does take off.
In another MVP question, in the MVP stage, what are you looking for as an investor if the platform doesn't yet have traction?
Well, traction is that's why I showed the graph. That's what I'm looking for, is that graph, right? And that graph shows traction. Without traction, it's really difficult to. Without traction of some kind, right? It's very difficult to build excitement. You can build excitement from someone who gets the idea, because you don't have a prototype yet, or maybe you don't have an MVP in order to show traction. But if you already have an MVP and you still don't have traction, then it's very difficult to generate excitement, because now you're at an even later stage than idea, and maybe it's because it's not going to work, and that would be the biggest fear that investors would have. So that's why one of the things that I recommend to people is go give away your product for free. One example that really resonated with me a long time ago is the Zappos story, which is the founder of Zappos, who wanted to sell shoes online, couldn't convince anyone that selling shoes online would be a thing that anybody would go for, because people would tell them that, you know, nobody's going to buy shoes online because they want to be able to try it on, see if it fits, and so on. So what he did is he went to his local Nordstrom store, took pictures of all the shoes at the local Nordstrom store, built a website, put those shoes online for the same prices, but offered free shipping and free exchanges if they don't work. So every time he sold a pair of shoes, he'd have to run to Nordstrom, buy the shoes, package it up, box it up, put all kinds of labor into it to do all of that work, and then pay for the shipping to ship it to a customer, in the hopes that the customer would keep the shoes. And if so, that he would only lose like $50 or $100 per pair of shoes because of all the work that he'd have to put into it. Now, the reason he did all of that and was willing to lose on for every pair of shoes that he sold is to prove out the idea and build excitement. That, hey, if I can sell 100 pairs of shoes and the numbers keep going up from week to week, it went from 4 pairs to 8 pairs to 20 pairs to 50 pairs, then I can sell, you know, 100,000 pairs of shoes. And because there's a lot of people out there, so you don't need to make money off of your first bunch of customers. You just need to eventually have the opportunity to make money. So you just want to prove out the idea.
I had one quick question. When I was looking at your S-curve graph of really hard, you know, too early, those
Right.
people that are coming to market, then, you know, in my mind, I'm thinking, so I'm going to put all this time in. It's really hard. I'm proving the idea. I'm testing it. And just for somebody else to come in and learn from my mistakes and probably hit.
Yes. Yes.
Talk about that a minute.
That's why, yeah, thank you. Well, I mean, you know, to build out, like, every technology or market goes through that S-curve. So if you're at the very beginning of that S-curve, it is really difficult to build out, you know, the both a good product, the technology, as well as convincing people that they even need it. So if you look at Tesla, for example, they started in 2003. And as late as just a couple of years ago, they were struggling so hard that people were calling, you know, saying that they might go bankrupt. And, you know, going bankrupt was not a realistic expectation for Tesla 3 years ago. But let's say it was in 2011, certainly before they had released the Model S yet, or 2012. So it took them nearly 10 years before they got to a point where EVs were coming to acceptance by anyone, and not even a significant portion of the market, by literally just a tiny, tiny, tiny fraction. So it is very difficult to build out the technology, build out the demand, if you will, and still succeed. If anything, Teslas of the world are the exceptions to that rule. You see much more frequently the Yahoos of the world who come in and build out a search engine, build out a directory engine, and then the Google comes in and does a better job, destroys them, right? Mm-hmm. Or the many MP3 players that were there before iPod came out and destroyed them. Or, you know, the BlackBerry that made the smartphone popular, and Microsoft's smartphone, and Motorola had smartphones, and Palm had smartphones, and then of course the iPhone came in and sort of destroyed them. So there's lots of examples of the destruction of somebody coming in at the right time into the marketplace, while that S-curve is growing rapidly, and just taking over the market as opposed to the very early players.
Awesome. Hamid, it's always just so wonderful to hear you talk. If you like this, you should subscribe to AZ Tech Beat for local Arizona tech news. He has a podcast, which is really fun and enlightening, and also azdisruptors.com if you want to pitch him and have him pick you apart, like he has explained today. He's also on Twitter and Clubhouse. Thank you so much, Hamid. Appreciate your time.
Yeah, absolutely. Thank you. Appreciate you.
All right,
Thanks,
take care.
Kate.
Yep, bye-bye.
You too.